Okay, let's unpack this one. Abercrombie and Fitch.
A familiar name for sure.
Right. You might know the brand, maybe even shop there or know someone who does. They just dropped their first quarter 2025 results.
And the initial headlines, well, they sounded fantastic, beating estimates.
Yeah, the stock actually soared right after the announcement.
But then things got a bit weird.
Totally. On the very day of the earnings call, the stock took, a pretty significant tumble, dropped nearly 15%.
So what on earth is the real story hiding behind those numbers?
Exactly. That's what we're going to figure out.
Right. And that stock movement is kind of the perfect starting point for our deep dive today. We're going to try and cut through that immediate market confusion.
Yeah, get to what was actually in Abercrombie and Fitch Co.'s first quarter earnings report.
And we're pulling directly from the official sources, the Q1 earnings call transcript, their investor presentation, and, news reports covering the results.
So our mission today isn't just to, read the numbers off a page. It's to really understand them.
We want to pinpoint the key financial highlights, dig into the reasons, both the good and the challenging behind what happened.
And figure out what it all signals for where the company's headed. And, most importantly, what does any of this mean for you?
Right. So let's maybe start with that top line number first, because it was genuinely strong.
It really was. They reported record net sales for Q1 fiscal 25, hitting $1.1 billion.
And that $1.1 billion, that's an 8% increase compared to the same time last year.
Plus, it was above their own guidance. They'd guided for, 4% to 6% growth?
Exactly. So beating your own target like that, that usually sends a stock higher.
Which it did initially.
But then came the call day, May 28th, and that sharp drop. It really suggests investors heard something in the details, maybe in the Q&A.
Something that brought in caution or concern about what's coming next, even with that strong Q1 beat.
It's a fascinating paradox, isn't it? Good numbers, thumbs up, then thumbs down on the explanation day.
So what do they signal about the rest of the year then? Did they lower the outlook after that stock reaction?
Well, actually, no. Reflecting that strong Q1 performance, they raised the top end of their full-year net sales growth outlook for fiscal 2025.
Oh, interesting.
They were previously guiding 3% to 5% growth for the whole year, and now they're expecting net sales growth between 3% and 6%.
Okay, so management's outlook on sales for the entire year is still positive, even slightly better.
Yeah, on the top line, definitely.
All right, so strong sales, raised sales outlook, but the stock dips hard on call day. There's definitely something else going on here.
It has to be.
Let's dive into where that record sales growth actually came from, because the source material makes it really clear. One brand was basically carrying the load.
Absolutely. The growth engine in Q1 was overwhelmingly the Hollister brand portfolio. That includes Gilly Hicks and their active line, too.
They saw remarkable double-digit growth.
And remarkable feels like the right word. Hollister's net sales jumped a massive 22%.
Wow.
And their comparable sales growth was 23%.
Okay, and comparable sales, it's tracking growth at stores open at least a year, right? Takes out the noise from new openings or closings.
Exactly. So 23% comps means those existing stores saw sales jump by nearly a quarter compared to last year. That's huge in retail.
Just huge, especially for a brand that big.
And it wasn't just a one-off good quarter either. The source points out this is Hollister's 8th consecutive quarter of comparable sales growth.
8 quarters in a row. That kind of consistency is powerful.
It really is.
So what did the company say was driving that specific success at Hollister? What's working so well?
They highlighted two main things: higher units sold and higher average unit retail, or AUR.
AUR, that's basically the average price an item sells for, right?
Correct. So selling more stuff and selling it at a higher average price, that points to strong product acceptance.
And crucially, less need for deep discounts or promotions.
Exactly. If customers really want the product, you don't have to slash prices as much.
Makes sense. Did they call out any specific strong categories?
Yes, they mentioned fleece, jeans, and skirts were particularly strong within Hollister.
Okay, it really sounds like they're hitting the mark with that Gen Z teen audience.
Yeah, the sources mentioned things like the grad shop, targeting culturally relevant moments for teens.
They're described as evolving, moving beyond just being a teen outfitter to being genuinely culturally relevant.
And that's a great example of what they call their agile operating model and read and react playbook in action.
Understanding the customer, responding quickly.
Right. And the growth wasn't just Hollister. They saw net sales growth across all their regions, too.
Right, let's tick those off. The Americas were up 7% overall, 4% comps. which is solid on top of strong growth last year.
Then EMEA, Europe, Middle East, Africa saw excellent growth, up 12%, 6% comps, continued strength in the UK, Germany.
And APAC, Asia Pacific, up 5%, with nice calm momentum from China mentioned.
So globally, the top line looked pretty solid.
It did, largely thanks to Hollister. But, okay, this brings us to the other side of the story. The challenges, the headwinds.
Yeah, because this is likely where some of that stock market concern came from.
And that other side of the coin is the performance of the core Abercrombie brands, Abercrombie and Fitch and Abercrombie Kids.
Exactly. While Hollister soared, the flagship brand actually saw a decline.
How much of a decline?
Net sales for the Abercrombie brand's segment fell 4% in Q1, and comparable sales were down 10%.
Oof, 10% comp decline. That's significant, especially next to Hollister's numbers.
It really stands out.
So what did management blame that on? Was it just a tough comparison to last year? Or?
They gave a few reasons. The main one was lower AUR, that average selling price again.
Okay.
They said they were working to clear out more winter carryover inventory than they had the previous year. Apparently, last year's Q1 was unusually clean on inventory, and performance was really strong.
So part of it is needing to clear old stock, which usually means lower prices.
And part of it is facing a tough comparison to an exceptionally strong Q1 in 2024, especially in some spring categories.
Did they give an example?
Yeah, they specifically mentioned that comparing this year's spring results to last year's successful wedding shop launch made things look softer.
Gotcha. So a mix of clearing product and just a really high bar from last year. But management thinks they can turn this around.
Yes, they seemed optimistic. They stated they expect to see sequential improvement in the Abercrombie brand's top line in Q2.
Sequential meaning quarter-over-quarter improvement.
Right. And they anticipate the brand will inflect positively, basically, see positive comp sales growth again in the back half of the year.
And that's based on getting through that inventory and reacting to new trends.
Yeah, using that read and react ability they talk about. They did mention YPB, their active lifestyle line, as a bright spot within the Abercrombie segment, performed well.
Okay, so a challenge at the brand level, but they think it's temporary and manageable. Where else did they face pressure that might explain that investor reaction?
Well, the operating margin contracted significantly.
Profitability taking a hit.
Yeah, it was 9.3% of sales in Q1, down pretty sharply from 12.7% in the same quarter last year.
That's nearly a 3.5 percentage point drop. Ouch. And the source material says that was mainly due to lower gross margin.
Exactly. Gross margin declined by 440 basis points year over year.
So 4.4% lower gross profit on sales. What drove that decline?
They broke it down pretty clearly. Over half the decline was due to elevated freight costs.
Still dealing with higher shipping costs, huh?
Seems like it. And the rest of the decline was due to that pressure from clearing the carryover inventory at the Abercrombie brand we just discussed.
Okay, so freight and ANF inventory clearance.
Right. Interestingly, the overall company's AUR was actually flat year over year.
How does that work if ANF AUR was down?
Because Hollister's strength selling at higher prices offset Abercrombie's weakness from clearing that inventory.
Yeah.
They balanced each other out at the company level.
Got it. Now, besides freight, there's another big external factor hitting their outlook, something impacting margins this year, tariffs.
Yes, this was a major point they highlighted. It's really impacting their full-year financial outlook and likely a big reason for that investor caution.
How big of an impact are we talking?
They estimate a roughly $50 million cost impact for 2025, specifically due to assumed tariffs.
$50 million. Wow.
Yeah.
What tariffs are those?
It includes an assumed 30% tariff on imports from China and a 10% tariff on most other global imports into the U.S.
Okay, $50 million straight to the bottom line costs. How does that translate into their profit margin forecast for the year?
They said it's expected to hit their full-year operating margin outlook by 100 basis points.
So 1 full percentage point lower margin just from tariffs.
Right. And that's the main reason they lowered their full-year operating margin guidance range. It's now 12.5% to 13.5%, down from their previous guidance of 14% to 15%.
Okay. That really puts the stock dip into perspective then.
Yeah.
Strong Q1 sales are great, but a $50 million tariff headwind and a lower full-year margin outlook, that's a significant challenge.
Absolutely. It's something they have to manage very carefully.
So what's the plan? How do they mitigate that $50 million hit? Are they just going to raise prices?
Well, the sources say they're focusing on mitigation efforts. Things like changes to their supply chain footprint, maybe sourcing less from China, perhaps.
Makes sense.
Also, vendor negotiations, trying to get better terms and driving efficiencies in their operating expenses.
So internal stuff mostly.
Right. And crucially, they specifically said they are not planning broad-based price increases just to offset the tariffs.
That's interesting. So they're trying to protect the customer from feeling it directly.
It seems so. Their strategy is still to get higher AURs, but through selling desirable product with lean inventory management, not just by hiking ticket prices across the board.
That sounds like a more sustainable strategic approach.
Ah,
Speaking of strategy, that agile operating model and read and react playbook came up a lot.
yes, they really position this as key to how they navigate such a dynamic retail world.
What does it mean in practice?
It basically means they don't lock in all their inventory decisions way in advance. They can adjust how much inventory they receive, where they spend marketing money based on what's actually selling, customer feedback.
And adapt to things like external pressures or, one brand doing way better than the other.
Exactly. It's how they plan to tackle the Abercrombie brand's issues and keep capitalizing on Hollister's momentum.
And they're not just relying on strategy, they're backing it up with significant investment dollars, too. Where's the money going?
They're investing in marketing, technology, looking at new channel partnerships, and importantly, putting significant investment into their physical stores.
Investing heavily in physical stores. That feels a bit counterintuitive these days, doesn't it, with everything moving online?
It might seem so, but they have a clear plan. They expect around $200 million in capital expenditures. That's money spent on long-term assets for 2025.
And a big chunk is for stores.
Yep. They're planning around 100 new experiences.
Experiences. Okay, retail buzzword alert. What does that actually mean?
Yeah. It breaks down to about 60 brand new stores and 40 remodels or right-sizings of existing ones.
Right sizings, meaning smaller stores.
Often, yeah. And the plan is actually to be net store openers. They expect to increase their total store count by about 40 locations, 60 openings versus maybe 20 closures.
And are these new, maybe smaller stores working?
They say yes. They specifically mentioned positive productivity and, interestingly, digital synergy from these new, smaller footprint stores.
Digital synergy, meaning the stores help online sales and vice versa.
Presumably. They called out their Williamsburg, Brooklyn opening as a successful example. These aren't the huge, dark ANF stores of the past. They're smaller, more modern, designed to work with their website and app.
Okay, that makes more sense. So investing in growth, what about returning cash to shareholders?
They're doing that too. They repurchased $200 million worth of their own shares in Q1.
Wow, $200 million in one quarter.
And they stated plans for around $400 million in total share buybacks for the whole year.
That definitely signals management confidence in the company's value and its ability to generate cash.
It usually does, yeah.
And overall, how's their financial health looking? Based on the sources, are they on solid ground?
The materials paint a picture of a strong financial position. They ended Q1 with $940 million in total liquidity.
Liquidity being how easily they can access cash.
Right. That includes $511 million in actual cash and equivalents. Plus, they have no long-term debt outstanding.
No long-term debt gives them a lot of flexibility.
Absolutely. Inventory levels were up 21% at cost year over year.
Which sounds high.
It does initially, but units were only up 6%. They framed this as being positioned for future growth.
How so?
They noted carryover levels were more normalized compared to last year's unusually low inventory. And the higher cost per unit was partly due to those freight costs and also some proactive tariff actions, like maybe building up some inventory before potential impacts hit.
Okay, so the inventory picture might be more nuanced than just the dollar value suggests.
Seems that way.
And finally, what about the very next quarter? Their Q2 outlook.
For Q2, they're guiding investors to expect net sales growth of 3% to 5%.
So continued growth, but maybe slowing a bit from Q1's 8%.
Yeah, and an operating margin in the range of 12% to 13%.
Okay, slightly better margin than Q1's 9.3%, but still reflecting some headwinds.
Right. That outlook reflects some remaining elevated freight costs and the ongoing tariff impact, even after mitigation efforts. They also expect to buy back another $50 million or so in shares during Q2.
Okay, so let's try and pull this all together. Abercrombie & Fitch Co. had a record sales quarter, right?
Yep, record Q1 sales.
Driven almost entirely by exceptional performance and growth at Hollister.
Hollister was definitely the star.
While their flagship Abercrombie brand faced some real challenges clearing old inventory, tough comparisons.
A definite drag in Q1.
And they're also staring down significant external cost pressures this year, especially from tariffs, which are hitting their full-year profit outlook.
That $50 million tariff impact is a big one.
But they seem to be responding from a position of financial strength. They have cash, no debt.
Solid balance sheet.
Armed with this agile read and react strategy, investing heavily in new, smaller stores and technology,
Putting money into future growth.
and returning a good chunk of cash to shareholders.
So a complex picture for sure.
It really is. Strong momentum in one area, navigating headwinds in another, facing macro costs, but executing a long-term plan.
That sums it up pretty well.
So why does diving into all these specific details about a clothing company's earnings matter to you listening right now?
Well, I think it gives you a really concrete look at how these big global economic factors like tariffs, freight costs, things you hear about in the news, how they directly translate into real challenges and strategic decisions for companies selling everyday products.
Yeah, it's not abstract anymore. You see the $50 million impact,
Yeah,
and you also see the complexity of running a multi-brand company in retail today.
exactly. How you have to balance the success of one brand like Hollister hitting it out of the park with teens against the struggles and the adjustments needed for another brand like Abercrombie.
It also shows the different things successful companies do with their money when they're financially healthy, right?
Yeah, not just investing internally in growth, like the stores and tech, but also returning value directly to shareholders through things like those big share buybacks.
And finally, I think it really highlights how important adaptability is in retail today. Having that flexible supply chain, that flexible operating model.
That read and react approach they keep mentioning. It isn't just corporate jargon, it's seemingly how they plan to try and stay ahead of fast-moving trends and unexpected challenges, like the Abercrombie inventory issue or the new tariffs.
Understanding these specific examples from a company like ANF just makes those broader business concepts, margin management, supply chain strategy, brand portfolios, feel much more real and understandable.
Absolutely, it brings it down to earth.
So this deep dive into Abercrombie & Fitch Co.'s Q1 2025 results really paints a picture, doesn't it?
Right.
A retail company hitting sales records thanks to one brand's explosive growth.
But facing specific execution challenges in another brand.
And grappling with significant external cost pressures, like tariffs, that are reshaping their profit expectations for the whole year.
Yet they're responding with significant investment in their future and returning capital from a strong financial base.
It really is a classic retail balancing act playing out on a large scale.
It is indeed.
So here's a final thought to leave you with. Given their confidence in that read and react strategy and their plans for turning Abercrombie around in the second half, can they actually pull it off? Can they execute that turnaround while keeping Hollister's incredible momentum going?
Or will those external pressures, tariffs, or maybe even faster shifts in what consumers want, will those pose bigger challenges than their playbook can handle?
Yeah, and what trends might you be seeing out there? In clothing styles, maybe related to those boho and Western looks they mentioned, or changes in denim leg shapes, are those aligning with what ANF seems to be reacting to?
Just something to ponder as you see what's hitting the racks or popping up online.